Well, good day, family. It's Coach Jay coming back at you. Family, listen at this. Please go back and watch the last 3 videos. We were talking about this young man making a decision to invest in himself. He know he didn't want to go to college and didn't want a student loan debt, all that hanging over his head. He's not even a college type. So guess what? Everybody's not the college type, and we do not need to force that on our kids, especially if we know that they really don't want to go to college. They may want to do something else out here and fulfill their purpose in life. Now, watch this. This young man, 20 years old. Actually 21 because he's going to get a CDL, but we were using 20, so basically we use a 30-year period that he's going to invest, bottom line. All right, so he goes out and gets the CDL. 21 years old. He's making $25 an hour as a bus driver. He's going to work 40-hour work week. He's going to do this and make $50,000 a year for earned income. Now, we did all the breakdown on the taxes, the standard deduction, all that. Go back and look at the other videos. Now watch this. We know that if he does the traditional over that 30-year period, he'll end up paying $64,000 taxes for his income taxes. And if he was to do the Roth, he would end up paying $118,000. But watch this. He knows that under the Roth plan, he'll never pay taxes on that money again, especially if you do the company match as well, because normally the company matches, it goes into the traditional. But because it's open up now where companies are allowed, and he found out his company knows that you can pay the tax on it now and never have to pay tax on it later, and he jumped in on it. Now watch this, family. When he turns the age of 60, $200,000 he can draw a year. We already did the math on all of that. So go back and look at the other videos. Now listen at this, family. He knows that, okay, if I get $200,000 a year, I'll never be taxed on this money. It won't count against my anything with Social Security and Medicare and all of that. He said, oh, this is a no-brainer. This is a no-brainer. I'll pay a little bit more taxes early on, but guess what? It catches up real quick, and it passes probably the 3-year mark. You have done better, and then going forward, it's like you're not paying taxes. They're still doing $37,000 a year on taxes alone, but off of that $200,000 that you're going to be withdrawing from that $5 million investment using the 4% rule of thumb. Now, he also knows, this is something we haven't talked about, there's an RMD. RMD is anything that's under traditional, whether it's a 401k plan, whether it's 403b plan, whether it's an IRA plan. You got to pay, it's called a minimum required distribution, RMD, every year. Once you turn, this year is 73, and when I go to retire, it's going to be 75. So, what? Guess what? With the Roth, you'll never pay taxes on that money. You'll never pay tax because you already paid taxes on it while it was small, while you were making a little money. But now you got this massive money coming in every year, $200,000 a year. It's not counted against any of your income. Family, Roth is a winner.